Dow theory is widely regarded as the bedrock of modern-day technical analysis, but more than 100 years since it was first introduced, how important is it in these days of high-tech indicators and computer-driven algorithms? Trevor Neil joins us now from BetaGroup, who has been an exponent of the Dow theory. We've spoken about this a number of times before. Just tell us whether or not it is something which we can still apply.
Yes, well, in part it is, but it was devised, as you said, more than 100 years ago, and some of it is out of date. But it's not out of date in the sense that the theory itself is out of date. It's just that how it would be done now is different. But it is the basis of modern technical analysis. Well,
let's take a look at the list, if we can. The list that we've got, which gives us the Six Tenets, yes, which form the basis of this. Just explain what's going on.
Okay. Before we go into that, just to talk about the man and his importance a little bit further. Charles Dow, he was the founder of Dow Jones, the company. He was the first editor of the Wall Street Journal. He was the creator of the Dow Jones Industrial Average. So these are contributions which still resonate today. He never had a theory. I would just want to make that clear. The Dow theory was actually written in a book called The Dow Theory Today by Robert Ray, and this was published in 1932 after he had died in 1902. So the thing we call the Dow theory, with the transport average and the Dow average itself, actually was not devised by him. He devised the averages, but not the kind of trading system. He was, as I say, he wrote only wrote editorials in the newspaper, which he was one of the founders of, but no book or anything like that. So other people wrote things which are attributed to him. So
these Six Tenets, are they not his writing then?
Yes, the Six Tenets are, and I want to separate them from what we know as the theory, because there's a lot of criticism of the theory itself. But the tenets, these things hold true today, and this is actually Charles Dow's own work, and really was revolutionary for us. It's also worth remembering, at the time there was no fundamental analysis.
Right.
There was no data. There was, because people, financial statements, people lied. Finance directors said they'd discovered gold in Tunbridge Wells, and they could do all those things, and they didn't come to go to jail. That wasn't until the Securities Act in 1932, I think it was, that became the law to tell the truth, to report correctly, and then you could have fundamental research because you had then reliable data. But up to this time, the market was full of lies. The only thing that didn't lie was the price.
Right. Okay. Well, let's take a look then at these Six Tenets and talk about the first one. The market has discounts everything. So what does that mean? So
what he meant by that was that he had there's a quote for him which I won't get quite right, but he says that everything that everybody knows about a stock, everything the management knows about the company, everything their bankers knows, everything their suppliers know, everything that the investment manager knows, everything that the retail investor knows, is distilled into the price. And the price knows everything, and it reflects everything accurately. And so if you know the price, you actually know the fundamentals, but also, more importantly, what they're worth to people.
Okay.
Now, it's very unlikely that you're going to know all the fundamentals yourself, but the market does, and you know them if you know the price. So if we study the price, we don't really need to study the fundamentals.
Right. Okay. But the price has now three movements, doesn't it?
Yes, it does. So we've got three movements. He was the first person to sort of talk about this. We have a primary trend, the secondary trend, and then tertiary trends. And he gave lengths of time to these. The primary trends lasting years, the secondary trends lasting 1 year to say 3 years, and then the tertiary trends measured in weeks and months. And so the primary trend can be interrupted by secondary trends which are against it, and then it too can be interrupted by tertiary trends, making this sort of fractal shape that we have in the market itself. So these are these overlaying short, intermediate and long-term trends in the market.
But that's different from phases, isn't it?
Yes. The phases was really bringing in psychology into it. So who is doing what in the different phases of a bull and a bear market. So in the first phase, as we start the clever and informed investors start to accumulate positions. The public are unaware at this stage, and the security starts to climb at that point. Then, as we go on, the public becomes more aware of it, and so we have this secondary phase where now the public is participating, and the price starts to go up. And then we go into a third phase, which is an exuberance phase, when the psychology changes and all the news is bullish and it'll go on forever, and this is a security you can buy for your grandchildren, and all the confidence increases as you go into this phase, and the price action often becomes parabolic at that time.
Let's catch up on a couple of charts where we've got some explanation of this. This is the Nasdaq, or the US Tech 100 we've on the IG platform. Explain this in what you've just been saying.
So if we can go back over on the left-hand side here, we've got what we've now called the Nasdaq Bubble, and this was an absolute classic Dow shape. We had the beginning phase, which was the new technologies that were coming in. Smart people were getting involved in it, recognizing the significance of this, and these technology stocks started to rise. And then we went through the late in the last decade, before the millennium, the phase where the market started to become, the public became aware, participated, everybody wanted to be in it, and then we went into the parabolic phase of a charging advance, and it was bubble then, and people just thought that this was everything, and if you buy in the morning you'll be rich in the afternoon, and this sort of thing. Then we went into the distribution phase, and this is a phase where the smart people actually realise enough is enough, and this is excessive and frothy, and begin to sell out to the public, who are often considered to be the last people to buy and get most bullish at the top, and they're being sold to by the people who understand the value of the security. Then we go into the first downward phase, and this phase is usually met with disbelief, and this is a buy opportunity, this is what we've been waiting for, and so forth. And often there's a rally, as there was in this case here, but we fail to make a new high, as has happened in 2001, and then it starts to tumble. Then the mood changes, because now really concern comes in. I can't believe this is happening. I never thought this was happening. What a disaster. I of course bought most of my longs much higher, at the high prices. Now this is really serious losses for me. Then the mood gradually goes into more and more despair and even hatred at the end of these moves, and people say things, I'll never trade stocks again, this was such a disaster, I've been conned, and this sort of thing. And this is a repetitive shape, and we can look at many different charts.
I was going to say, just quickly overlay Bitcoin on this.
Yes.
You've got the same sort of thing.
So just in case anybody were to think that this used to be the case, here's a market this is a modern and up-to-date one, and here we've got the same pattern here. We've got the awareness phase where the smart people begin to realise that we've got something new here, which may be groundbreaking and changing. Then the public starts to get involved in it and reading about it, see how interesting it is and how it might be something. Then we go into the phase of exuberance there, and bubble, and really people don't really care what the fundamentals are. I just want to buy it because it keeps going up and I get richer. Yeah. Then we get the distribution phase there, at the point of maximum bullishness in the ill-informed public, if I can call it that, and some of the clever people are taking their profits at this point. Then we get once again, as we did see in the Nasdaq, that rally, which is the first move down, a reaction to the first move down, which people thought was a buy opportunity, and at long last I can buy cheap Bitcoin. Yes. And then it failed and crashed, and we go through the moods down into despair, and then now we're starting it all again, I think.
Let's take a look at the next tenet, and that is the averages must confirm each other.
Yes. Now this is he devised, as we know, the Dow Jones Industrial Average. Originally there were 12 stocks in the average. It expanded over time to 30 stocks as it is today, and this was the blue chip stocks, and it's an average, it's not an index. And I'll come back to this later, talk about why that might not be good. But it is a way of describing the market. There was no description of the market. There was no FTSE at that time, even though there'd been a stock market in London for 200 years.
Right.
There was no average. You either owned this plantation or this mine and you made money, but nobody really thought there was any value in looking at the market as a whole. But Dow realized that something was driving the market other than the profitability of the securities, which was the economic cycle. And you could only see it if you could in some way measure the market. So he created this very simple, and I mean it was mathematically very simple. It's merely it's a price weighted using a divisor to normalize the data. There's no dividends paid back into it. It would be much higher if there were, like as the S&P has its dividends included in the index. So it's an average and not an index. It's a simple measurement. Now that's something we'll come back to in a moment. He created the second average, which was the transport average. Originally it was the railroad average, which now is the transport average. And the railroad average was really a good forward indicator of the confidence of the industrial sector. So the industrial average, the blue chip industrial stocks, in those days America was a heavy industrial economy. It produced things in big industrial centres. It brought raw materials from around the country to make things. Then it distributed the finished products out to the nation. There was only one way of doing that, and it was by railroad. And so railroad was really an intention of how the managers of factories felt about the condition of the market, and it would be the profitability of the railroad was a leading indicator of what was likely to happen in the industrial average. So he said that if the two agree with each other, then we've got a good condition, we've got optimism in the managers as well as profitability in the industrials. But a warning is when the transport average starts to wane, and so the railroads weren't making money. This is because they were cancelling railroad contracts, and this would often come at the terminal phase.
And of course now the transportation index is mostly
airlines,
which of course,
yes,
100 years ago wasn't the case.
It wasn't the case, and also, really, does it stand up?
No.
And again, I'd like to come back to that.
Yeah. Okay. Let's take a look at the trends confirmed by volume.
Yes. Now, he also recognised that that in order for securities to keep going up, we needed the volume. We needed people to buy it. And how do you see it? Well, that's turnover, that's volume, that is people buying it. And so a good condition of the market, a strong condition of the market, is that the price is going up and the volume is going up. This means even as the price increases, people still think it's cheap and are willing to buy it and pay more for it. A thing which you often see at the ends of moves is a change of mood after a long bull run, that people become reluctant to pay up. They say, well, I know the news is bullish, but there's a very high price, we've gone up very fast, I've got all I need, and therefore the volume starts to dry up as an early indicator. And likewise on the way down, if you're going down and the volume is increasing, this means that as you go down, still people want to liquidate, still they think it's worth selling even down here, till the end, when often it comes, even though the news is bad, people say it's not worth selling down here, we're too near the zero is the bottom, it's too low to sell, I've sold everything I need, and that means a small amount of buying can turn the market up again.
And of course the last tenet is picking up on that point and saying the trend remains until it stops.
Until it stops and it changes. And so the trend remains, so we have a way of defining the trend. Higher highs and higher lows is a definition of a rising market, and the fact that was said first more than 100 years ago is still true today. Higher lows is going up, and that will always be the case. And so because everybody knows it and it's 100 years old doesn't make it not true. It's still true. But the problem is the topping area there. He is very keen that you stay with the trend until you see clear evidence the trend is over. Time you see clear evidence of the trend being over, it's not the top. By definition, it's not the top. And actually, by the time you see a reversal in the trend and you break the pattern of rising lows and you form the first zigzag downwards and go down, up, and then make a new low, which is a new downtrend, then you're well off the top.
And just stepping back from this, having covered the Six Tenets, I think this really enables me to talk about some of the shortfalls of what's going on here, because Dow doesn't enable you to mark the top or the bottom of a market.
No, that's right. So there are really three problems with Dow Theory, but I do want to sort of separate Dow Theory, not Charles Dow's work, from the tenets. Tenets are still correct, but the theory as such is weak. We were talking about the transport average. The transport average is not a leading indicator anymore. The profitability of airlines is the price of fuel. It's not to do with the intentions of the industrial sector. The average itself is really much criticised by people, and it is widely followed, and most people, the Dow was up 100 today, and they know what that means. But actually it's not a representative, it's really not a representative number at all. It's a narrowly based, it's arithmetic, there's no dividends in it. The S&P 500 is much more general view of the market, and then for a broad view we might use the Russell 2000, but maybe that's too broad, so people like the S&P 500, but the Dow is too narrow. And then this final criticism is about the lateness on it. It really, for you to know there's a new trend that's taken place, even if it's from up to sideways or if it's up to down, this means for you to see the full construction to take place, you may have lost already 25% of the price movement before you can say we're in a downtrend. So if you subtract 25% from the beginning, 25% from the end, and may not be enough left in between the two to make it worthwhile. Okay,
look, Trevor, we've got to leave it there, but it's a quick scoot through Charles Dow, Dow Theory, and whether or not it still applies to the markets today. That's Trevor Neil from BetaGroup.